Welcome back to The Explainer. Today we're unpacking a really fascinating strategy from the Money Blueprint. And honestly, it promises to completely transform how you look at your charts. If you've been struggling with frustrating trading losses, that terrible feeling like the market is literally out to get you, well, this breakdown is exactly what you need. We're going to dive into how to turn those really painful losses into razor-sharp institutional edges by mastering the breaker block strategy and learning exactly how to trade the flip zone.
I mean, picture this. Have you ever set up a perfectly calculated limit order right at an order block, waited maybe hours or even days for the price to hit it, only to watch the market just smash right through it like it wasn't even there? It takes out your stop loss and then, as if to mock you, perfectly retests that exact same box from the other side before going in your original direction. It feels like terrible luck, right? Well, according to the data, it's not luck at all. It's just mechanics.
Okay, let's start with Section 1, the retail liquidity trap.
To stop getting caught in these aggressive market moves, we really have to dig into the underlying mechanics of why these obvious breakout levels fail in the first place. There's a massive disconnect between a trapped retail mindset and a highly profitable institutional approach. The retail trader is constantly buying the breakout, jumping in the exact second price pushes above a high, or stubbornly holding on to failed order blocks, just hoping and praying for a turnaround. But smart money? They're deliberately hunting those stop losses and trading the breaker retest. It's wild to realize, but the institutions are playing an entirely different game.
Moving on to Section 2, BOS versus Chach.
So if you want to trade alongside smart money, you've got to intimately understand the true structure of the market. Look, if you feel like every single time you buy a breakout, the market instantly reverses and targets your stop loss, hear this loud and clear. You aren't unlucky. Most retail traders jump into a trade the moment price breaks above a high because, well, that's what traditional textbooks teach us. But the market makers know this. They deliberately push price past these obvious levels just to grab your stop loss orders before sending the market in its real direction. Basically, you're just being used as liquidity.
And that is exactly why you need to identify a change of character, or a choach. A choach happens when the market breaks its very first key low or high. And this is crucial, specifically with a full candle body close. This right here is your ultimate early warning shot. It's the market flashing a neon sign saying momentum has officially shifted and smart money is flipping the trend. We're not just talking about a wick sweeping liquidity. It's a complete structural failure, confirmed by a full candle body closing right past that level.
So here's the absolute crucial difference you need to remember. A break of structure, or BOS, means the current trend is continuing strong. It's just business as usual. But a change of character, that means momentum is shifting, the trend is completely flipping, and the party is pretty much over for the current direction. We really need to stop buying into liquidity sweeps hoping for a standard break of structure. Instead, wait for a clean, definitive CH, let the price pull back, and then enter with the real trend.
All right, Section 3, anatomy of a breaker block.
So we know the trend is flipping, right? But how do we actually capitalize on that? What exactly happens to an order block when it just totally fails? Let's say a green order block is supposed to hold, but price smashes right through it, breaking down completely. Notice what happens next. The price usually returns to that exact zone, flipping it into what's known as the flip zone or a breaker block. The rule here is incredibly profound. When an order block fails, it doesn't just disappear, it converts. These failed zones actually become some of the absolute most powerful institutional levels on your entire chart. Let's walk through exactly how this happens, how a bullish setup suddenly flips into a bearish opportunity. A bearish breaker block basically starts its life as a regular, everyday bullish order block. But it fails. Why? Because price created a higher high, meaning it swept liquidity right at the top, and then aggressively crashed straight down below the low of that order block. The very moment price closes below that low with strong momentum, boom, that box officially flips.
Now, why does this work so incredibly well? Well, it's all about trap volume. Imagine you're a trader who just bought at that bullish order block. When price crashes right through it, you're instantly stuck underwater in a massive losing position. Panic sets in, right? What do? You wait and you pray for price to come back to your entry so you can just get out at break even with zero loss. When price finally returns to that broken box, all those trapped traders aggressively close out their buy positions. But remember, to close a buy, you have to sell. This creates this massive, concentrated influx of sell orders, which is exactly what launches the price downward in the new direction. Smart money is literally using that retail panic to their advantage.
Which leads us to Section 4, 3 valid breaker rules.
Look, we need to set some boundaries here. Because let me be absolutely clear, not every broken box on your chart is suddenly a breaker block.
If you just go around trading every failed level, you are going to blow your account. You need strict rules. So here are the 3 mandatory criteria you need to validate a high probability breaker block. First up, the liquidity sweep. Price absolutely must spike past a previous high or low to grab those stop losses first. Second, displacement. Price has to break through the order block with strong, aggressive candle bodies, ideally leaving a nice fair value gap behind. And third, an unmitigated retest. Price must pull back cleanly into that broken box to fill those mitigation orders. If you have those 3 elements lined up, you are looking at an incredibly high win rate setup.
All right, Section 5, Trade Execution and Targets.
Okay, so we've got the theory down, we know the rules. Now, how do we actually execute this thing? How do we put our money on the line and target profit safely? Well, here is your blueprint. Step 1, place your limit entry right at the front edge or even the 50% midpoint of the breaker block. Step 2, tuck your stop loss safely behind the recent liquidity sweep high to protect your capital. Because hey, if price goes all the way back up there, the setup is totally invalidated anyway. And step 3, target the next major draw on liquidity, like an old low, aiming for a minimum of a 1-to-3 risk-to-reward ratio.
And you know, I really work to reassure you about this specific setup. The main reason we absolutely love trading the flip zone is that breaker blocks align perfectly with aggressive institutional displacement. When you enter at these levels, you're essentially stepping into the market at the exact moment institutions are injecting massive volume. Because of this, these setups often result in very rapid price expansion with extremely minimal drawdown. You're not just sitting in a trade sweating it out for days, the market usually reacts violently and immediately in your favor.
Finally, Section 6, Respecting the Market Flip.
It's really time to make that mental shift. Stop being a victim of the retail liquidity trap and start thinking like a cold, calculated institutional trader. Stop treating failed order blocks as bad luck. They aren't mistakes, they're literally roadmaps. Treat them as fresh, incredibly high probability breaker block opportunities. You absolutely have to respect the flip. By the way, the original creators of this strategy over at The Money Blueprint highly recommend checking out their daily Substack newsletter for written technical guides and even more daily chart notes on this exact topic.
So tomorrow morning, when you're looking at your charts and you see one of those obvious levels break while the retail crowd panics, you've got to ask yourself one question. Are you going to be the liquidity or are you going to trade the flip? Protect your capital, build your blueprint, and we'll see you in the next explainer.